Amazon put $8 billion into Anthropic. On paper, that stake is now worth $74 billion, a 9x return. Before the company went public, before you could buy a single share. Now Anthropic is filing for IPO, and every headline is calling it the moment retail investors finally get access. But here is what those headlines did not ask. In any deal where the biggest investors are already sitting on 9 times their money, who exactly is the exit? I switched from ChatGPT to Claude earlier this year. Same story as a lot of you. I love Claude much more than ChatGPT. So when the S1 dropped on June 1st, 2026, my instinct was the same one I imagined you had. I want to own the company. So I did the research. And what I found is what this video is about. Anthropic was founded in late 2021 by 14 people who walked out of OpenAI on the same day. Dario Amodei had been OpenAI's VP of Research. His sister, Danielle, had run operations. They left together. Their reason stated publicly: OpenAI was not taking AI safety seriously enough. So they built a company whose founding premise was the opposite. That company makes Claude, the AI a lot of you switched to when ChatGPT started frustrating you. On June 1st, 2026, it filed a confidential S1 with the SEC. Confidential means the document is not public yet. That is standard procedure. The full filing becomes public roughly 15 days before the IPO roadshow begins. The target listing window is October 2026. But I found something about the CEO of the company that most coverage is not talking about. I'm going to get there. It reframes everything. Now, here's what you are being asked to buy. The most recent private valuation, $965 billion. That round closed on May 28, 2026, 3 days before the S1 filed. The IPO is targeting above $1 trillion. That is already more than what last week's institutional investors paid. And those investors got months of financial access and private negotiation before writing their checks. You are being asked to pay a higher price on a document you cannot read yet. You are paying more for less information. That is the deal being offered. The revenue story is extraordinary. Anthropic went from $1 billion in annualized revenue at the end of 2024 to $47 billion by May 2026, 47 times in 18 months. Dario described it as crazy 80x growth. But here is the first thing I need you to hold before we go deeper. That $47 billion number may be $8 billion smaller than it looks. Anthropic is like the real estate agent who records the full $1 million sale as their revenue without deducting the $970,000 that actually went to the seller. When an enterprise customer buys Claude through Amazon's cloud platform, Anthropic records the full dollar. Amazon's cut is recorded as a cost. OpenAI's own internal analysis put Anthropic's real number at roughly $8 billion less than what is being quoted. Have you ever seen a real estate agent make $1 million in commission on a single deal? That is not fraud, but every analyst pricing this stock will quietly build their own adjusted number before they model it. You should know what they are adjusting before they do. At $1 trillion against the stated $47 billion in annualized revenue, Anthropic trades at about 21 times forward revenue. Nvidia, after one of the most extraordinary stock runs in history, trades at 25 to 30 times forward revenue. Salesforce is 6 to 8 times. Microsoft is 12 to 14 times. So 21 times is not insane for a business growing this fast. But it requires multiple things to go right at the same time. I found 3 that are not going right yet. In May 2026, The Wall Street Journal reported that Anthropic expected its first ever operating profit in Q2, $559 million. 12 days later, the S1 filed. Every headline treated those as two separate events that happened to coincide: profitability and the IPO. Two pieces of good news. They are not two separate events. Anthropic signed a deal with SpaceX to use their Colossus 2 data centers. The cost, $1.25 billion per month, $15 billion a year. That is Anthropic's single largest operating expense. And that deal includes a discounted opening rate. That discounted period covers May and June 2026, the exact 2 months of Q2 2026. Elon confirmed the structure publicly. 180 days total, including the discounted opening period. After 180 days, the price is subject to renegotiation. It could go up, it could go down. Nobody knows yet. Read that again. Anthropic's first profitable quarter exists because its largest cost is temporarily subsidized by Elon, whose other company is xAI, Grok, Anthropic's supposed competitor. The rivals are financially co-dependent. There is more. Large enterprise customers are reportedly paying $50 million token prepayments upfront. Anthropic books those immediately as revenue. The compute required to deliver those tokens is spread across 12 months. This inflates reported revenue in their near term and suppresses cost in the same reporting window. The $559 million profit may partly be a question of when money was counted, not how much money exists. Anthropic's own CFO acknowledged what comes next. The company, quote, might not remain profitable for the full year as it plans spending increases due to vast computing needs. They said that and filed the S1 12 days later. One more number I could not set aside. In a March 2026 court document, Anthropic's CFO stated in writing that revenues had exceeded $5 billion to date. At the same time, ARR figures being shared with investors imply substantially higher monthly revenue. Both cannot be true simultaneously. That discrepancy will need to be resolved in the public S1. The company had burned through $24.8 billion over 5 years to arrive at a single quarter of conditional profitability on a discounted cost base. The question is not whether the technology is real. The question is whether the business underneath it is. That answer is not available to you yet. Here is a picture no single headline drew. Amazon committed up to $33 billion to Anthropic. Google committed up to $40 billion. Combined, $73 billion. Every headline caught that investment. Confidence. The biggest names in tech backing the best AI. Here is what their investment looks like as a structure. Amazon is simultaneously Anthropic's investor, Anthropic's largest compute vendor, and the cloud platform through which a large portion of Anthropic's enterprise revenue flows. When a business accesses Claude from Amazon Web Services, Amazon captures margin on the compute, distributes the product, and holds an equity stake in the company generating the revenue. 3 separate financial relationships with the same company, all pointing the same direction. Amazon has no board seat, no voting rights, no governance control, but it sits at 3 points the money cycle at once. Google's position is structurally identical. 14% ownership, no board seats, revenue flowing through Google Cloud. Now, here is the number I stopped on. In Q1 2026, Amazon reported a $16.8 billion pre-tax gain from its Anthropic stake. Google reported similar gains. The Fortune headline from April 30th said it plainly. Half of both companies' reported AI profits that quarter were paper gains on an unlisted private company, not profits from their own AI products. Their stocks went up. Retail investors who owned Amazon and Google cheered. The underlying source was an accounting markup on a company that had not yet gone public. The moment Anthropic IPOs, those stakes become liquid and auditable at market price. If the public market values Anthropic below $695 billion, Amazon and Google book mark-to-market losses. The same IPO that gives you access could trigger reported losses for the two companies most visibly associated with Anthropic's success. If you watched my SpaceX IPO video, you already understand the lockup mechanism and what happens when large investors can finally sell. The Anthropic structure is different, but the sequence holds. Link in the description. Are you following the shape of this? Because what you have not heard yet is what happens to your rights once you are inside it. Does that circular structure, Amazon and Google as investor, vendor, and distributor simultaneously read to you like confidence in Anthropic, or like a moat around the business that mostly benefits the people already inside it? Tell me in the comments. When you buy a share of Apple, Microsoft, or Nvidia, you own equity in the company with a fiduciary duty to shareholders. If management destroys value, you can vote them out, support an activist, or sue for breach of duty. Those are your rights. Anthropic has a different structure. It is a public benefit corporation. It has a long-term benefit trust. 5 financially independent people who hold the right to appoint a majority of Anthropic's board. The trust's primary obligation is to, quote, the long-term benefit of humanity, not to you. If Anthropic decides to slow commercial deployment for safety reasons, you have no recourse. If the trust blocks a product line that would increase your returns, you have no recourse. There is a kill switch. A supermajority of investors can vote to abolish the trust and remove its directors. That sounds protective, but read it carefully. Either the safety mission is genuine, in which case you are buying stock in a company where your financial interests can be legally overridden by 5 unelected people, or the kill switch makes the safety mission largely symbolic, because investors can dissolve it the moment it costs them money. One of those has to be true. Both cannot be. And you will not find out which one until the trust and the shareholders went different things for the first time. A Harvard Law School paper published May 11, 2026 looked at every comparable structure in history. 2 examples. Ben and Jerry's Mission Guardian Board triggered boycotts, $1 billion in state divestments, CEO dismissal, and founder resignations. OpenAI's Guardian Board fired Sam Altman in November 2023. You likely remember that. The company nearly collapsed. The decision was reversed within 72 hours. Every safety-focused director was subsequently removed. The governance structure was abandoned. Anthropic's version of this has never been tested in a public company. Both prior attempts ended with the mission structure being dismantled. You are not just buying the stock. You are buying into a governance design that has 0 for 2 record when it meets real pressure. Most investors never dig into governance. Most of the time, it does not matter. At Anthropic, it might be the thing that matters most. Does it make sense? If it is, hit like. It helps this reach the next person trying to make this same call before the IPO opens. In February 2026, 90 days before the S-1 filed, the United States Department of Defense issued Anthropic an ultimatum. The Pentagon demanded Anthropic remove all safety restrictions from its models for, quote, any lawful use. The specific requests: autonomous weapon systems and mass domestic surveillance. Refused, and the Pentagon threatened to officially designate Anthropic a supply chain risk. That label has previously been reserved for Chinese state-linked entities. It had never been applied to an American company. Dario published a statement on Anthropic's website. These threats do not change our position. We cannot, in good conscience, accede to the Pentagon's request. A Pentagon official responded publicly. They called it a liar with a God complex. Think about what that sequence looks like. The US government threatens to designate you a national security risk. You refuse publicly. A government official attacks you by name. Then you walk into the White House in April 2026 to negotiate your way back in. Then you file a $1 trillion IPO in June. In a podcast published in February 2026, the same month as the Pentagon confrontation, Dario said this: "The pressure to survive economically while also keeping our values is just incredible. We are trying to keep this 10x revenue curve going. There is zero time for bullshit. There is zero time for feeling productive when we are not." There is not a prepared investor statement. There is a founder under real pressure saying what it actually feels like inside. I want to say something here directly. Most of you using Claude are using it for real work. Writing, research, coding, thinking through hard problems. The product works. That is not a marketing claim. It is why you switched. The mission Dario describes, AI that is powerful without being reckless, is the product you are already relying on. Whether that mission survives the transition to a public company with $1 trillion shareholder expectations is a different question. One this filing does not answer. In October 2024, Dario published a 15,000-word essay on his personal website, Machines of Loving Grace. He argued that AI could compress decades of cancer research into 5 to 10 years, near eliminate depression, extend healthy human lifespan. He described Anthropic as the thing standing between humanity and a catastrophic AI future. 18 months later, he filed to take that company public at $1 trillion. And in November 2025, in a CBS News interview that aired nationally, he said, "I think I'm deeply uncomfortable with these decisions being made by a few companies, by a few people." As of mid-2026, Dario Amodei's estimated net worth is $7 billion. That is more than twice Sam Altman's, the man he left OpenAI to escape because Altman was not taking safety seriously enough. I am not telling you what that means for the investment. I am showing you what the timeline looks like when you put it in one place. Here is the question the whole video has been building toward. A beloved product going public at a high valuation while losing money, with institutions who got in early position to exit. This pattern played out twice in the last decade, with completely opposite outcomes. The first time, Snap, March 2nd, 2017. Snap makes Snapchat, millions of users, product that used every day. IPO at $17 per share, $24 billion market cap, about 36 times trailing revenue. 13 underwriter analysts initiated coverage on the day of listing. All 13 rated it buy or outperform. The same 13 firms with underwriting fees at stake. The stock hit $29 in the first days. Retail investors who missed the IPO price chased it. December 2018, $4.82. People who bought it at the high lost over 80%. As of mid-2026, Snap still trades below its IPO price, nearly a decade later. The second time, Palantir, September 30th, 2020. Enterprise data and AI, government dependent, money losing. When it listed, analysts genuinely disagreed on what kind of business it even was. Retail investors who bought in the 2021 hype when the stock hit $45 were destroyed in 2022 when it fell 65%. Then AI became real. Palantir's platform turned out to be exactly the trusted, auditable AI infrastructure that enterprise customers needed. The stock gained 167% in 2023, 340% in 2024, 135% in 2025. A $1,000 investment at the direct listing is worth roughly $18,000 today. That is an 18x return in 5 years. Two companies, same entry pattern, completely opposite outcomes. The difference was not the product. Both products were real. Both had genuine users. The difference was whether the business underneath the product was sticky. The metric that measures that for an enterprise AI company is called Net Revenue Retention, NRR. In plain English, of the enterprise customers who were paying last year, how much more are they paying this year? Above 120% means existing customers are expanding. Below 100 means they are contracting. Anthropic has not disclosed its NRR, not in any pre-IPO materials, not once. You are being asked to choose between the Snap outcome and the Palantir outcome for a company where the one number that tells you which path you are on is not available in any document you can read today. That number will be in the full public S1. It is the first thing I am looking for the moment it drops. I went back and looked at how I am thinking about it personally. The product love is real. I use Claude every day. I switched because it was better and it has stayed better. But what I kept running into in this research was a specific question I could not resolve. Not whether the technology works, whether the financial story being told is designed to be understood, or designed to make people who love the product feel certain enough to act before the audited books exist. I do not have an answer to that yet, and I want to be honest about that before you make any decisions. Here are the 3 signals I am personally watching before this stock is anywhere near my portfolio. 1. The public S1, expected September 2026. When it drops, find the NRR figure immediately. That number tells you more about whether this is Snap or Palantir than any other single data point. If it is above 120%, the Palantir case becomes real. If it is below 100%, the product love is not translating to business stickiness. Everything else in the filing is context around that one number. 2. Q3 2026 gross margins. The SpaceX compute discount window closes around July 2026. The first quarter without that subsidy will show whether Anthropic's reported 70% gross margin holds when the full rate arrives. If it drops materially, the path to 77% margins by 2008, the path this valuation needs, becomes very hard to justify. 3. What Amazon and Google do at lockup expiry. They are sitting on near 10 times their money. If the two investors with the most information about this business choose to sell the first moment they legally can, they are telling you exactly how they value the stock at $1 trillion. Amazon put $8 billion into Anthropic. The stake is now worth $74 billion before you could buy a single share. The company that made the AI you switch to is founding to go public, and the financial story it is telling was designed for exactly one audience: people who already love the product. The question is whether that love is information, or whether it is the level. When the full S1 drops and the NRR is finally on the page, will it be the number that confirms what you already believe? Or the number that makes you ask why nobody put it in front of you sooner? If this breakdown was useful, hit like and subscribe. I go 3 layers deep every week, and the full Anthropic S1 breakdown is coming the day that document goes public.